I'm from a family of CPAs, and lately, every time I say that, they bring up the movie My Cousin Vinny, where she says. Because honestly, my father's a CPA, my sister's a CPA, my brother, my son, my niece, my nephew, like, we're all CPAs. So everyone, I didn't even make that connection until someone said that, and I'm like, oh, that is true. Everybody are CPAs. So I have a great resource of folks in my life who help me on my path of growth. And so we're gonna get started on tax planning for the self-employed. And like I said, if there's things that you want to ask along the way. Okay, awesome, thank you. Okay, yeah, to start off with a little humor. The IRS, like the sign says, it's all theirs. Honestly, it took me like till yesterday or last year to even realize that if you do combine those words, the IRS, it is theirs. Tax simplification, I keep hoping for it. I'm happy to find another career path because the tax code has gotten so complex that we stay in our lane of what we want to know about. As everyone knows, we're not gonna stay too long on this slide, but the Inflation Reduction Act, IRS is ramping up their trying to make them more modern. If anyone's ever tried to reach the IRS, they know what we're talking about, and it takes them a long time to get back to you. Correspondence is tough. And they will also be adding more revenue agents. We already see that in our office. And we're seeing it at the state level as well, especially Connecticut. New York has always been very, I don't know if aggressive is the right word, but very diligent about getting notices out and things. And DRS is certainly up their game as well. Areas of focus are going to continue to be cryptocurrency, S corporation compensation, foreign accounts, and business partnerships. The agenda today, to remind you that the tax code is not simple. It's full of thresholds and phase outs and limits and credits and so whatever I say, just know there's some kind of exception or exemption that goes along with it. We're going to evaluate the sole proprietorship to determine whether that structure is right for you. The S corp status is still a popular vehicle to change your sole proprietorship into an S corporation. We'll quickly touch on that. Bonus depreciation or reducing self-employment tax, because that's what we really need to start talking about. Mm-hmm. If you've heard of this QBI deduction, this qualified business income deduction, a lot of these things are set to sunset at the end of 2025 as well. We don't think they're going to sunset, although they keep talking about it, but we will know as we know more down the pike, then we'll keep updating. Retirement plans, there's a lot of options for sole proprietors. We're going to touch on that lightly. Again, we're going to try to stay high level. And then again, the S corp, how and why you would want to convert to an S corporation. So a sole proprietorship is an unincorporated business. A lot of you are LLCs, which really isn't a tax term. It's more of a legal term saying they're limited liability corporation, but it really doesn't talk about your tax structure. When you signed up to get your EIN from the IRS, it'll say sole member, which means that you are self-employed and that your income and expenses will be reported on a Schedule C. And that is within your individual 1040. So you have your income and you have your deductible expenses, and then that profit is taxed. The real difference between, and forgive me if I'm repeating things that you already know, but I want to just start with the basics and then we can move on from there. If you're an employee, you receive a W-2 from your employer, and you have federal withholding taken out. May not be at the right tax rate, but at least you have some federal withholding taken out. And you also have the employee's portion of Social Security and Medicare that come out of your W-2. So that the employer is paying half of it, and you as the employee are paying half of that. That's really one of the big differences between being an employee and a self-employed individual, is that now you not only have to pay ordinary tax rates on your taxable income, but you also have to pay both the employee and the employer portion of Social Security and Medicare. So it's really important to monitor your income along the year so that there are no big surprises at the end of the year. Mm-hmm.
So when I teach young people, because I do money in your 20s, they don't believe me, what you just said.
Well, it's true.
So have you found that like when you really explain like the burden of being an entrepreneur to a
It
young
takes
person?
it takes a while to get that, to get that point across, because if you've ever been a W-2 employee,
Mhm.
you have that taken out
Mhm.
automatically. And you're only responsible for half of it.
If you're a single owner LLC, does that mean all of the checks and everything have to be paid to the LLC, or is sole proprietor interchangeable?
Yeah, it really is. It really
Okay.
is. I feel like if you're going to be an LLC and have that protection, then you should run it through your EIN or your business name, because that's what the LLC offers, but it's
I'm
not.
saying that because the bank fees are outrageous.
Oh,
compared to
yeah, you're right. They are true.
individuals.
Yeah, it is interchangeable.
Okay,
But there
thank
are
you.
reasons to protect, to shield your own,
Yes.
the ownership.
Mhm.
Could I just ask one question? So when they don't believe me, right?
Yes.
This makes me old. No, this is really true. It's after, you have your revenue and you have your expenses in your
Mhm.
business.
Mhm.
And it's that, just that profit
The
number.
profit, yes,
That you're,
the net
so
profit.
there's nothing funky about that. It's not like you should always pay more off of your revenue. I mean, you're allowed to come up with your profit number if you do
Correct.
it the right way.
Correct, yes.
So it's only off of that profit.
Yes, your profit.
Okay, thank
Yeah,
you.
it's based on your profit. And then, because nothing's simple, you pay as the sole proprietor, you pay in as if you're the employer and the employee. You do get an adjustment to your adjusted gross income of half of that self-employment tax that you pay, so it's not dollar for dollar. But it is a big burden for self-employed people, and that's why it's really important to pay in quarterly estimated tax payments. When you, and if you, certainly if you're doing a big project and you have a big influx of income in a particular month, that you might want to consider either putting that aside or making a monthly estimated tax payment. I know I do that during tax season. There's a direct pay link right with the IRS that you can go on and make estimated tax payments. You don't have to write out a check and send in the voucher.
Before you go on,
Yeah.
just reference the adjustment you spoke of.
Oh, so on your 1040, you
Yeah.
have all your types of income,
Yes,
and then that's your total income.
right.
Then you have your adjustments to income is the next
Your
section.
expenses.
No, it's more of the half of the self-employment tax. The
Okay.
Schedule C is completely different. That number just flows into your 1040. But it could be, if you have a SEP plan as a sole proprietor,
Mhm.
that when you calculate your you calculate your maximum SEP contribution that you're allowed. And then if you can either pay that maximum amount or you can pay a less amount. That's also an adjustment to your gross income so that it brings down your
Taxable.
taxable income.
Okay.
If you choose to do the estimated tax payments,
Mhm.
if you make that decision once, are you bound to have to always do estimated?
As a Schedule C, you have to, there's no other way to pay in your taxes, unless you pay on April 15th, but then you're going to incur an underpayment penalty. Because you have to pay in, depends on your income, again, there's thresholds and these limitations. So it depends what your income is, if you have to pay in 90% of last year's tax or 110% of last year, 90% of current tax or 110% of last year's tax. So that you don't get stuck with this underpayment penalty, which
Can you
is,
just pay 100% of last year's tax?
again, I don't make the rules.
It's 120%.
But yeah, but it depends on your income level. But there's ways to, like I said, get around that, but say you, most of your income is earned in the fourth quarter, you can annualize your income so that it lessens the burden of that underpayment penalty. Okay, again, this is the US tax code, 30 million words. Let's put it all together and let's see what we come up with. Again, here's some things that we talked about already, but if some of these numbers have not been adjusted, I tried to catch them all. But obviously, some of these numbers are old, they've been adjusted for inflation, but we'll go on from that. Schedule C, it's report on Schedule C. Your profit is subject to self-employment tax that we've talked about. A loss from your business reduces your self-employment income. But you have to be tricky with that. It's tricky with that because if you report losses for like 3 years and you're not reporting profit, the IRS starts to look at that as a hobby versus income. So you just need to be mindful of that. And for startup businesses, There's a lot of traction with that right now of, you really can't deduct all your startup expenses at one time. When you're a startup, you can deduct $5,000 and the rest technically has to be amortized over 180 months. So you can't just say, oh, I had travel, I had research costs and no income. The IRS really is getting tough on that kind of stuff. So you would want to amortize that and deduct some of those expenses in future years. Again, we talked about the self-employment tax rate that is still 12.4%. So that's the combination of, like we were talking about, the employer and the employee. As an employee, you're paying 6.2 and the employer is paying 6.2 for Social Security, and then Medicare is still 2.9%. The rate now is for 2024 is about 167,000, I believe, somewhere around that number. So that your income up to that point is subject to Social Security. After that, it's subject just to Medicare. And of course, they can't just leave it at that. Medicare used to be had a limitation number. Now, if your income is over, I think it's 250 for married filing jointly, if you both have Schedule C income. Now you have to pay an extra point, you have to pay the 2.9% and a surcharge of 0.9%. I don't make these rules because it's getting to be very expensive to be self-employed.
Sure is.
Yeah.
If you have multiple streams of income and one is constantly, in the loss, but is helping to generate a revenue every other
Yeah.
places, you need those separate at Schedule C.
Yes.
Is that a red flag?
No, you can have separate, if they're different businesses, then you would want to.
But it doesn't
Yeah.
become the hobby
Right.
as a red flag
well,
auditor potentially?
I guess I'd have to look at it as on a case by case basis for that, but the one thing that you do have to take into account, and we see this more often now, is now. I don't know the threshold off the top of my head. I think it's around $400,000. If you make $400,000 or more and you have a business loss, it actually gets limited. You can't take that whole business loss in the current year. It has to be carried over. That's a relatively new one, but that's kind of getting into the weeds a bit. So I am gonna try to stay a little bit high level. So this is the 2023 Schedule C. So for you out there that are solopreneurs, this should look familiar to you. This is where you report your income from your business. So you have your gross receipts. And one thing to be mindful of is that when your clients are issuing you 1099s, right? Not everyone is going to send you a 1099 depending on the threshold. Some are still not complying with that. But you do want to make sure that this gross receipts number that you're showing here is at least or more than your 1099s that have been sent to you. Because the IRS does check that, because that's why they get the 1099, so they know with your EIN or your Social Security number, how much your 1099s are. So you want to make sure, first of all, that number is more than your 1099s. And the other thing that I'll mention about this form, part 2, those are your expenses. The IRS likes you to use these lines and not put them on other expense lines. Of course, you're going to have to, because not everything is here, but make sure you look at these lines to see if your expenses can be put on here. Because the whole way that IRS generates notices is based on a convoluted, kind of like a point system, where depending on which lines are filled out, it accumulates this value, and that's one of the ways that they know who they're gonna pull.
And do they compare year to year? Also have, like, because TurboTax will often compare year to year.
Oh, yeah, our tax software does that too, but we do that in terms of, business growth and analysis to see where the trends are and what you're spending more on or less on, or maybe we don't have something that we had last year. I see you have this $10,000 deduction. Where is it for 2023? That's a really valuable piece for us. I think more the IRS is looking at, they don't want you to generate losses year after year, because then to them, that means it's a hobby and not a.
From expenses.
Yeah, from an expenses. They don't want you to have a net loss.
Is there a rule on
Yeah.
issuing 1099s? I know it's a little off.
$600 or more.
But you have to, as a business?
You should be in compliance, yes. But you only issue 1099s to other LLCs. You don't send them to corporations. They're self-employed people, partnerships, businesses, but if they're corporations, you don't have to or individuals, you would send them a 1099. Yeah. The IRS hasn't gotten too crazy about that compliance for what I've seen. I haven't ever seen a notice come through like you didn't issue 1099s.
What other areas are red flags for the IRS?
On Schedule Cs,
Yeah.
I would say, the set contributions, things like that, you wanna make sure that you're calculating the correct maximum contribution that you can make.
What is a set contribution?
The self-employed, it's a SEP IRA, like a retirement.
Okay.
plan.
But do you feel if we're using a program like TurboTax, that we could be pretty confident? in
Yeah, to get the
calculation,
maximum, yeah,
Yeah.
because it's basically 25%,
Basing it on.
but it's basing on,
Program.
it can't just be on one number that they
Right.
base it on, you have to add and subtract different things and then multiply by 25%. I know in our firm, we always double check the calculation.
Which I would have.
Some calculations now, like, when it comes to capital gains and things, like, some of these calculations are getting ridiculous and trying to figure out how they all work. This is the page 2, cost of goods sold, unless you have, inventory and those kind of businesses, you may not even be filling up that top part. Part 4 is for your business vehicle. So, the way that works for deducting, you have a business vehicle, you need to figure out how much you're gonna allocate towards business, unless you have another car that's available for personal, right? You can't take 100% of your business vehicle if you use it for personal reasons. You would look at what your actual expenses are. And then you would calculate, the IRS gives you a standard mileage deduction, I think it's up to 56 cents per mile or something like that. So you would figure out your business miles, multiply it by that IRS stated amount, and then you would see which is higher. Are your actual expenses higher, or is this standard mileage rate higher? So you would use either of the two. And then this other expenses line, this is where you would put in things like continuing education or dues and subscriptions or things that are not pre-populated on
Okay,
page
that's
1.
good to know. Can I ask you a question
Yeah.
on cost of goods sold on the
Mhm.
page? So if I act as an agent, right, so I'm
Mhm.
subcontracting out and then I'm having, percentage, is that where that cost of goods sold goes, where I'm paying out someone to do my
So like
work?
subcontractors.
Subcontractors,
Yeah, I've seen, it can be either within that body of it can be under contract labor, for
Okay.
instance, on page 1. That's where we tend to put it
You
versus
do,
cost of
okay.
goods sold.
Okay, that would be more
Typically-
material.
Yeah, it'd be cotton, right, it'd
Products,
be, yeah,
okay.
yeah. It depends on the business.
If
Yeah.
we're on QuickBooks,
Mhm.
are the categories the same as the categories you're expected to use on this?
I don't think so. I don't think that some are for sure, insurance or advertising, some of those are, but in terms of what's pre-populated through QuickBooks, they're not exactly the same.
Okay,
But you can certainly adapt your QuickBooks for these categories.
okay.
Mhm. Again, if I mention this quickly, just making sure that your gross receipts is higher than your 1099s that you receive. And then the 1099s that we're referring to, they changed it a few years ago. It's a 1099 NEC, which is to report non-employee compensation. So those are your subcontractors that are helping you with projects and other services that are,
You say that your 1090, that your gross receipt should be higher than your 1099.
1099 that you
But what if,
receive, yeah.
but what if all your work is 2 1099s, then it would be equal?
It would, right, it could be
Oh.
equal, but if you do a small job that's under $600 or
Right,
something,
right.
and then some businesses don't comply.
Absolutely,
But your
I've had that,
QuickBooks, yeah,
right, and
but your
I
QuickBooks
always
says that.
enter it in as if it's I always enter it in the program as if it was a 1099 that was received. I
Yes.
guess.
Yes, so it gets added in.
So that
Correct. You wanna pick it up.
subcontract work should get a 1099 NEC?
Yes,
Okay,
yes, the folks that are doing work for
Yeah.
you, yes, as long as they're not a corporation, you want
Okay.
1099. Prepay, I mean, one of the ways to have extra deductions if you have a high income year would be to prepay your expenses using the IRS safe harbor. It's possible to do it. I don't really do it that often, but
Can
it
you
is a
explain what
strategy that you
is,
can.
what the safe
So if you
harbor
you
is?
can prepay your rent for the year, so that, for the next year, so that you don't have, so that you take it as an expense, say in twenty
Oh, so you're taking
twenty-four.
it, you're
You're taking
taking the
twenty
prior
twenty-four,
year.
even though you may be paying it in 2025. And then if your landlord gets that in the next year, they can pick it up in income next year, but you're getting it as a deduction in the previous year. It's, I don't see it too widely used, but it is, this one, and I'm taking these from all of, strategies that we see. You can also, make more collections if you want to have more income in your year, or you can, just by not billing your customers, or you can hold off, billing them until the next year, if that makes
So
sense.
hold the income so it doesn't end up
Yeah,
in,
so it doesn't end up there. I'm not a huge fan from that standpoint of keeping your financial house in order. Buying office equipment, that's obviously a way to reduce, your net profit. Bonus depreciation, you probably heard of it before, where if you're buying a computer or even a vehicle, if it's a business vehicle, that's subject to different limitations as well. But you can take advantage of bonus depreciation. Last year, it was not last year, meaning 2022, it was 100%. So if you bought a piece of equipment that was really valuable and the work that you do for, let's say $5,000, you were able to take a $5,000 depreciation deduction in that year instead of depreciating it over the useful life of 5 years. But now they're reducing that bonus depreciation 20% each year. So in 2023, it was 80%, in 2020.
if you
2023
bought
was
it.
80%, 2024 is gonna be 60%.
But if you're running your QuickBooks on cash and you buy that $5,000 computer and you just cash it out as an expense, you can't take the depreciation.
Correct.
Right.
It's one you're taking the, right.
It's one.
But you wouldn't get, well, and that's where, again, everything, as soon as I say something and I want it to be simple, and then I have to add in, another idea. There's bonus depreciation and there's section 179 depreciation. So just
That's not going
because.
away, section 179.
179, right? So bonus depreciation was great when it was 100%, because that was like a no-brainer, like,
Buy a car.
yeah, like just vehicles are subject to limitations. You can't take 100% bonus depreciation, unless it's like a work van or something like that. But they do have section 179, which you can, take 100% of this $5,000 piece of equipment. But the real difference between bonus depreciation and section 179 is taking that section 179 expense cannot generate a loss.
Mhm.
So
That's the
bonus
trick.
right, so bonus depreciation, if you were on that break even cusp and you have this $5,000 piece of equipment, that can actually generate a loss for you, but section 179, you're not allowed to take section 179 in excess of your profit.
If you do buy that piece of equipment, do you have to notify the town? Because then they're gonna tax you on that asset.
Yeah, I mean, through your property tax
Yeah.
returns, yeah, that's a drag too.
That's a
You have to-
drag.
I know those, we don't handle any of that, we leave that reporting up to our clients, but yes, you have to report those. And then each year it gets, the cost of it gets reduced. in
Right, but
terms
you
of
can
tax.
take the 80%, but the
Oh, you
town,
would report it on the full
Right.
value, yes. Mhm. Yeah. Because self-employment taxes, we've been discussing, is such a burden. Because you're not only subject, your net profit's not only subject to ordinary tax rates. And then subject to this self-employment tax, which is your Social Security and Medicare, it adds up to a lot. If you have real estate, if a joint couple and real estate is owned by your spouse, you can actually rent space from them, which would create an additional expense on your Schedule C, which would reduce your self-employment tax. And then you would report the rental income on a Schedule E, which is not subject to self-employment tax. So it's a way of taking it off your Schedule C and putting it on a Schedule E. So Schedule C being your sole proprietor income and the Schedule E being your rental income. And on a Schedule E, just like the Schedule C that we brought up, you are allowed deductible expenses against that rental income as well. So it's a way of shifting income from your sole proprietor into.
So the rental
property.
income is not taxed at
It's
the SC
right,
tax.
correct. It's subject to ordinary tax rates.
including the additional depreciation, right, from that
Right,
property, so you're.
right, you would, yes, you would be able to get a depreciation write-off and insurance and things like that, yeah. Yeah, this is just talking about, there obviously is a lot of documentation that would need to go involved in that, and making sure that everything has your rental agreement, and 1099s need to be issued and that kind of thing. And one thing to note, I don't know if you have heard of this net investment income tax, which is relatively new as well.
No.
It's an additional tax that's imposed on your investment income.
Mhm.
So,
When did that start?
seems like a while now, we've been dealing with this, it probably was with the Tax Cuts and Jobs Act of 2017. It's probably
Big
about,
Affordable Care
which one was it?
Affordable Care.
Affordable Care Act? Yeah, I mean, there have been more changes, since 2020, or with that Tax Cuts and Jobs Act of 2017. There's been more tax changes than in 40 years before that.
Mhm.
Yeah. So the 3.8% is good to keep in mind. Let's see, what's this one? Oh, this was, okay, so now I have the correct, limitations for the self-employed tax. I'm just repeating kind of the same thing, just to let you know how much this self-employment tax affects your tax return when you're a sole proprietor. So it's really just, again, reemphasizing this Social Security tax and Medicare tax. And the reminder to make federal and state quarterly estimated tax payments. And again, you don't have to wait until quarterly, you can always issue them or send in money monthly if that works better for you. Another idea for sole proprietors is when you have children who are at that age where you can have them render some services for you. So this is a chart that helps you know when it's taxable, if it's subject to FICA, or FICA meaning Social Security and Medicare, FUTA meaning federal unemployment tax. Really the most important thing are these things at the bottom. They're only deductible if the work is done in connection with the trade or business to the child actually renders service, and the wages are reasonable and actually paid. So it has to, you have to go through all those renditions to make sure. The kiddie tax, if you've heard of that before, it's for minor children, because a lot of parents were shifting over investment income to their children who were getting taxed at a lower rate. So now they have this kiddie tax where if it's above a certain range, then it actually gets taxed at the parents' tax rates. But if you're paying them wages, this earned income would not be subject to kiddie tax. The child's earned income is often taxed at a lower rate. And then this earned income allows your child to contribute to an IRA, which is pretty cool as well. And then there's possible education credits, but that goes in the realm of if they're a dependent or not. So that's pretty tricky to be
At
able
what
to do.
age can they start earning?
I don't, I actually have to do more research on that because I'm getting asked that a lot more now by my clients who have young children, because they want them to, be like, models in their marketing promotions and that kind of stuff. So for next time, or email me to remember, and I'm gonna find out more guidance about it for sure. Like we talked about the startup costs, you can deduct up to $5,000 of startup costs and then amortize the remainder over 180 months. I just heard a story, someone was asking me if I would take on their
Where would you report the startup costs on Schedule C?
yes, yeah.
On that
Schedule C.
section 5? Or
I would probably put startup costs on that other expenses
Okay.
category. And then when you have to amortize it, then it would be going on a different line of
Okay.
amortization. When you're attempting to start a new business, that there's gonna be costs incurred before you're really generating income.
Right.
Travel, research, all those other things, but not my clients, but I was approached by someone who's having a really hard time because the IRS disallowed like $50,000 of expenses. And they're saying they were just investigating a business. They were disallowed. They're not allowing the deductions. So it's something to be mindful of, that the IRS is really cracking down on the expenses with no income. So one of the strategies is to generate income early, right? To be able to show some income on the tax return, so that it helps substantiate that you are actually in business and are allowed to take these deductions. And then if you start generating these income, revenue producing activity, for instance, you're starting your business, you're working out of your home, you start to grow, you get office space. And if you're already generating revenue, that will be able to help you deduct moving costs or other things that are associated with moving from your home office into a rented space. So another thing to just remember. Don't assume you're taking too many deductions. I think a lot of people are nervous about taking deductions, but as long as they are bona fide business deductions, you should be able to take those deductions without concern, making sure that you have the proper documentation. And, but I do get asked that a lot, they don't want to take too many deductions, but like I said, when you're a startup, it's hard to do when you're not generating any income, but after that, you should be able to take the deductions that you're entitled to.
How long do you usually have to keep the paperwork on that?
3 years is the statute, so.
Didn't it used to be 7?
Yeah, I thought it was.
The statute runs 3 years after you file your tax return. So if you file on April 15th, 3 years later, the IRS can't come back.
Good.
Yeah, I mean, I know
I have
people.
boxes
I
to
know,
throw
I
out
know
now.
people keep them for 6 years and
Yeah.
things. I mean, I can only speak from my standpoint of my work papers and my tax returns. Like, I do not have to keep them after 3 years.
That's good.
Can I ask you this question
Yes.
about the hobby thing?
Yes.
So I started in 2019, definitely a loss. Then we had the pandemic. So
Mhm.
it's just, you're just going sideways, but you're registering a loss. But now there's like profit or whatever.
Right.
But if they go back and they go backward and they audit, where they say, oh, you had 3 years of a loss, you're automatically a hobby. Is that how that works?
No, it's just a kind of a rule of thumb that if you had losses in the past 3 out of 5 years, they start to look at.
It's not like
possibility of
the
a hobby.
computer immediately flags it,
No.
immediately says,
No, because
because,
first of all, it has to get pulled,
yeah,
right, from this sea of tax returns.
right.
Which is part of that, each line item is associated like a certain value, and that's
Yeah.
one of the ways that they.
And we're not talking big losses here.
Yeah,
It's just
no,
like,
I
once the
get it.
pandemic hit, it was like,
Yeah.
you're just gonna go.
Well, I
sideways.
think that
It's just so
the
weird.
IRS has to take that into consideration.
Yeah.
The COVID years, so, the 2019s would be already April 15th, if you filed that April 15th, that would be closed, April 15th, because.
I just know we
Yeah.
did that. Like, I must have had 3 years of losses by accident because of the pandemic.
Yeah.
Cause you're just
Yeah.
going sideways, you're deducting your
Yeah,
internet.
and again, like you say, if
Web
there's small
feeds.
losses, it's not
These are
like you're,
small
right, so,
losses, yeah.
that definitely plays into it as well.
Oh, yeah, they're
Yeah,
small. They're
yeah.
small. Okay,
That definitely plays into
well,
it.
that's good.
Yeah.
A little scary.
And if that's your only source of income is your Schedule C and you have a loss, then you could possibly have an NOL, a net operating loss. And in the old days, you would be able to go back and amend your tax returns and claim that net operating loss, but they got rid of that with the Tax Cuts and Jobs Act. And now you can only carry forward your NOL. Not that we want anyone in this room to have NOLs, because we are all generating income,
Right.
right? And so you can only carry it forward and you can only offset it by 80% of your taxable income. It's like, what does this all mean? Never stop documenting your deductions and always claim your rightful deductions. So that's what we want to do, is keep the proper documentation in case you get a notice. Section 199A, we're not going to stay too long on this, but that is a really nice deduction that was allowed with the Tax Cuts and Jobs Act. If you're within these certain parameters, you're able to take a deduction of 20% of your taxable income. Again, I say that loosely because it's not just taking your net profit off your Schedule C. There's certain additions and subtractions that have to happen to come up with that number. For instance, a SEP contribution, you would have to add that or subtract that from your taxable income. And another good point is, I don't know why I always forget about talking about it, but self-employed health insurance deduction, that's another big deduction that does not go on your Schedule C. your health, your self-employed health insurance deduction. That is another example of those adjustments to tax, the adjustments
So I
that
had
we
a
were talking
question
about.
on that.
Mhm.
Years ago, I had my own plan, and so I was able to do it through this, not through the Schedule C, but through, through the,
On 1040, right,
Yeah.
adjustment to gross income.
but now my insurance goes through my husband's retirement plan, but we have to pay for it.
Mhm.
So there's no way that I can do the paying and take that off.
I think you can. I mean, I'll,
Or my portion of it.
yeah, you definitely can do that if it's not through an employer situation.
So
You
it would
should
be
able to
through
do
like
that.
his retirement
Yeah,
from when
yeah,
he worked in Arizona.
Yeah, it should. I'm gonna say it should, because I'm like 99%.
Because would I
certain, but
have to
I'll
be
leave
the
that
one
there.
that writes the checks?
Again, we get into this issue of your social
Semantics.
security
Because I have
number,
it.
your EIN.
Yeah.
I do, let me look at that, cause I don't wanna say something that
I'm
they'll go
just
later
curious
and be like,
because They just
Oh.
switched to the ability to pay for this by credit card, which would, give us some cash.
oh,
back
yeah,
with the
yeah.
credit card.
Mhm.
But I could do it through my business
Yes,
credit
You
card,
should be able to do that.
and so I could contact you maybe independently to follow up on that,
definitely,
like the
definitely,
next
yeah.
year.
Yeah,
I mean,
and that's a
would make a
good point.
difference.
I'm gonna put that in my mind to make sure that I address that as well, because I think that's
What
what
about the medical
So-
expenses, like deductible medical expenses or things that aren't
you,
covered?
you wouldn't be able to take that on Schedule C. The only time that medical expenses are deductible if you're a C corporation, you could take those right on your C corporation tax return, but if you itemize your deductions, you can get medical expenses. You're saying as a self-employed person?
I'm not sure what I'm saying. I'm just
Yeah,
trying to-
yeah. No medical
I think
expenses
I'm
can
curious,
be,
but
can be
Where-
deducted on Schedule C. That would have to be part of your itemized deductions, your Schedule A, itemized
Or
deductions.
E, that's only.
B, for rental property, no, you wouldn't be able to take medical expenses there.
So your health premium is a deduction as an adjustment.
Yes, it
And-
doesn't go on Schedule C, because it doesn't really reduce your.
Severage line.
Mhm.
So if you're self-employed, you can deduct that?
Health insurance?
Yeah.
Yes. Not on Schedule C,
Okay.
but through an adjustment.
And then your medical
I would love to be
expenses, your
able to do that.
co-pays are a portion of your adjusted gross income.
That's gonna be an itemized deduction.
Yeah,
Out of pocket medical expenses,
On an A, schedule.
Schedule A, but here we go again. You can only claim medical expenses on Schedule A that are above 7.5% of your adjusted gross.
That's the trick, never meets.
And which, no, it's very, and you don't want it, right?
Yeah,
don't
no.
want that. You don't- We don't want that
But if you're-
deduction based
But
on
if you're
this.
self-employed and you're taking a portion, like say my portion of the health insurance, that would be, I couldn't take my husband's portion, but my portion, and we're not doing a Schedule A, I would still be able to do
Yes.
that for my Schedule
Yes.
C.
Yes,
If I'm.
yes, you
if
just
I'm
wouldn't
paying
report it
through-
on your Schedule C, you report it as adjustment to gross income.
Okay, do you think if it's being pulled out of my husband's, if it's being pulled out of a bank account, but it's a joint account,
Yeah,
do you think I can still take it?
I would have to look at it.
2023?
I don't wanna
I don't,
speak out
maybe I
of.
should just think of it for next year and plan for.
Yeah,
2025.
I would
think I
think you'd
might-
be able to, but I'd wanna research it a
So I'd
little
have to
bit more
speak to you
before I tell
quickly
somebody.
because 2024 is getting, 2022 is getting submitted soon.
So-
Well, there's always extensions.
so if my husband.
Don't be afraid of extensions either, honestly. People are like, I need to file by April 15th. No, you don't.
Just pay your tax.
Yeah, right. Extension is an extension of time, not an extension of tax.
So
Right,
if my husband is on social security and he has a Schedule C, I read someplace that we could deduct his Medicare Part B on the Schedule C under insurance. So we're,
That I don't know.
but that's an adjustment.
honestly.
The health insurance that he's paying, that they automatically deduct out of the social security income is an adjustment to income. Is that true? Like, where does he deduct the premiums to his insurance on Medicare?
That's, let me think about that and I'll get back to you on that.
Thank you.
Yeah, I know what you're saying. I know what you're saying. So getting back to the schedule or the section 199, if you fall within the parameters, you can take 20% of your Schedule C with adjustments. And that goes on your Form 1040 as well as a separate line item. So when you're looking at your tax returns, when you're reviewing, when your CPA gives you your tax return to read, you'll wanna look at that Form 1040. I don't know what line number it is, but it says qualified business income deduction. Again, it depends on your type of business, because it's either you're a trader business, or you're a specialized service, which has a lot more limitations, I'll say. The specified service, I'm sure a lot of us fall into this in this category, I know I do, is if it's based on your skill set and reputation, then you're a specialized service person and you fall into these certain limitations more than you would if it's a trader business. It's the areas of accounting, consulting, financial, medical, performers, all those reputation, special skill set services are considered specialized services. Real estate, they were added into being trader business, and also architects as well. They had great lobbying groups to be able to get included in the trader business section. Some ways to, this, again, I'm gonna not go too much into the weeds, but I want you to know that there are certain ways to increase your ability to take this QBI deduction, because like I said, it does get phased out at certain limits. So the idea is to increase your taxable income if it makes sense for your situation. Again, it's not going to be right for every person. It really is a individual case by case scenario. But harvesting capital losses, the capital gains would get added to your taxable income, and then it builds your eligibility for the Section 199. Making charitable contributions. Again, we're getting back to the Schedule A. A lot of people aren't able to itemize anymore because the limit on state and local taxes is now $10,000. That's all your state withholding and your state taxes and your real estate property taxes and your personal property taxes. So you're left with home mortgage interest and charitable contributions. So one, not even for only self-employed people, but one of the tax strategies is if you're philanthropic, you may want to bunch together your charitable contributions in 1 year so that you're allowed to take the itemized deduction versus losing that as a deduction. Because if you don't, the standard deduction, let's say it's $28,000, that's not the exact number, but your itemized deductions would have to be over $28,000 for you to get any benefit of your itemized deductions.
It's 27.5.
27.5 for 2024. I'm not sure what they changed them through inflation. So if you bunch together your charitable contributions, perhaps you're able to itemize in 2024 versus if you pledge $5,000 each year to the charity of your choice and you lose the deduction, you could pay it more upfront, bunch them together so that you're able to itemize. And again, we talked about buying business assets and the benefit of taking bonus depreciation or section 179.
And Tracy said
Yes.
5 minutes.
5 minutes? Wow, we gotta get talking. Establish, I know, I'm telling you, I could stay here all day. I'm happy to have so many people who wanna talk taxes. Establishing your retirement plan. Again, we talked about the SEP. It's a great vehicle to be able to help reduce your tax burden. So make sure that you look into that. And if you set up a SEP, you put yourself on extension, you have until the time you file your tax returns to make your SEP contribution. So you don't have to make that by April 15th, but you have to be on extension. You can't pay in your SEP late if you're not on extension. Peers, feel free to take some pictures, or I can send it to you if you want. These are sole proprietors. This is if you're self-employed and have no employees, these are like your options of how it equates if you're an employee and how it equates if you're a sole proprietor. So we're not gonna stay on this because we're running out of time, but take a picture or I can send it to you. This is the same thing, but for S corporations and C corps. We won't get into that today, but home office deductions, another big area for self-employed people, right? If you're using your home office, you have to be careful in establishing your square footage for your office versus your home. They really want you to be particular that this is what this office space is used for, and it's not for your pool table in the room, even though you use it as like spare place for your papers. If people are playing pool and mingling in there on a personal basis, then you wouldn't be able to include that in your square footage. Again,
So
I've never
if I
seen that
have
challenge.
My office in my bedroom, that would be a problem.
It's a tricky one, but I've never seen it challenged, so some of these things that I say, you know, I've never seen the home office deduction challenged. There's also a simplified way, you can take a $1,500 home office deduction without going through all those calculations. Because you would want to look at your insurance and your utilities and all that, and then you would come up with your
Percentage.
if it's 7%, 10%, whatever it is. You can't deduct Starbucks as a workspace. Another great idea, converting to a Roth IRA when you're starting your businesses and they're low income years. Remember that you can convert your traditional IRAs into Roth IRAs and pay the tax if you're in a lower tax bracket. If you're like, next year, or the year after, I'm gonna be in this higher tax bracket, maybe you wanna consider converting some of your traditional IRAs into Roth IRAs so that you're paying the tax at a lower rate. They're becoming Roth IRAs, and then upon distribution, you're not going to get taxed on them. I think we've talked a little bit about that. S corporation conversions, maybe we'll have a separate class on that. Because I do think it's still a valuable tool. One of the benefits of this S corporation status is that you pay yourself a reasonable compensation on a W-2, you take all your expenses, and that bottom line is not subject to self-employment tax, whereas it is on the Schedule C. You're paying yourself reasonable compensation on a W-2, but your bottom line for your S corporation is not subject to self-employment.
You're filing two tax returns.
You are,
then.
you have to file a 1120S and your 1040. You receive a K1 from this S corporation, which then flows into your 1040. One of the other benefits is state taxes. With the SALT cap at $10,000, you're not able to take those deductions. If you're an S corporation, you pay the state taxes, they call them pass-through entity taxes, you pay that at the Connecticut level, if it's a Connecticut S corporation, so that you're able to get that deduction on your S corporation tax return. It's not dollar for dollar, but it's a very good planning point. You have to, if you want to be an S corporation, you have to submit the proper paperwork, Form 2553, getting a new EIN, all of that stuff in the first 75 days of the month. So typically by March 15th. So it's done for the year to be able to be an S corp for this year. And reasonable compensation, again, if you're an S corporation, you want it to be a reasonable compensation, looking at comparable compensation in similar businesses as yours. Again, reasonable compensation. Wow, had a lot on that one. Oh, good, good. I mean, I kind of ran through it at the end, but hopefully you took away some nuggets. I know I try to cover it simply, but then also have to add in all the caveats that exist in that web of
That's
tax
great.
code.
That's great. I'm sorry I have to run.
Yes, no,
run out
I
to the meeting. It was
understand.
fantastic.
I understand. Thank you. Thank you. Good. Like I said, I could talk about it for hours and I really do. I do appreciate you all being here and wanting to talk about taxes. I'm in Stanford, but I'm actually moving into Haven. Yeah, on April 22nd.